Want to know why once this crisis starts, it's probably not going to stop? That's what we're going to talk about today, coming up. I'm Lynette Zang, and welcome to ITM Trading. You know, there are things that are called doom loops, and there's 5 different doom loops which kind of keep going around and around and around once they begin. We experienced this actually during the 2007-2008 crisis. We experienced it during the sovereign debt crisis in Europe, and quite frankly, with the central banks trying to remove the punch bowl, so to speak, we're experiencing it again. But once these kick into gear in a big way, they're really hard to reverse. So I wanted to talk to you about all of them today, and we are going to begin with what you really need to know. And we're going to talk first about the intermediate doom loop, because this comes directly from the banks, which, as we saw in 2008 when they bailed them out, they need the banks to transmit through the economy, and they need the banks to be able to lend because it's a debt-based system. So in 2008, when the interbank lending froze, and of course we know what the results of that are, well, that was a problem. That's when governments had to really start injecting capital into the system and making a lot more dollars available, and governments themselves spending a lot more taxpayer dollars, whether it was to inject it into the banks or some other form of quote-unquote stimulus, though you really have to look at who they're stimulating. But the problem with this is when that happens inside of the banking system, governments step in, central bankers step in to support the system, and the public perceives it as underwriting the banks. And so there is that notch confidence in your government having your best interest at heart when they see this kind of behavior. And that means that it's dangerous for those that want to remain in power, whether it's governments or it's central banks. And that's really the key risk in here, is the image of central banks and governments supporting banks to the detriment of the public. And we're going to be talking more about that in another slide on the 30 risks that we face in 2019. So this, when it emanates from the banks, then it also impacts the sovereign, which is the government doom loop, the collateral doom loop, because the banks hold all that fiat money collateral, and the hedging doom loop with all those derivative products that they've created. So we're going to look at those one at a time. And now we're going to the sovereign doom loop, because what that really does is reflect those links between the government, the central bank, and then the commercial bank, which is really the tool that the central bank and the governments use to push their policy out through the economy. So using an example, because I want you to see this a little bit better, and thinking about 2008 when the crisis unfolded, what did they do? They lowered interest rates all the way to 0 to inspire a lot of borrowing, and then the government did and injected that taxpayer borrowing into the banks, because they also started paying them interest to encourage them to hold on to those reserves. But the interest that they were charging them at 0 and the interest that they were paying them now on excess reserves were free profits for the banks. Doesn't really inspire lending, but what they were trying to do is to keep the banks profitable. And unfortunately, because the interest rates have been held so low for so long, that negatively impacts the bank's earnings. And so banks, like everybody else almost, went out on the risk spectrum and leveraged up, because that's what banks know. They know leverage and they know debt, and leveraged up and put us all in the very precarious position that we're in right now. So with all of that debt that they took on zero, we know that since mid-2016, interest rates have been rising. Well, as we know, okay, when interest rates rise, the principal value of the bond falls. When interest rates go down, the principal value of the bond goes up. So all of those private corporate banks that bought the government debt with the free money that the government gave them, they're holding those bonds on their balance sheet at a certain price level. When the interest rates go up, like it has been, I mean, just lately it hasn't because of flight to safety, but that's a different deal. Rates have been rising since mid-2016. That impacts the value that the banks, or the equity rather, I should say, that the banks have on their books in a negative way. That in turn, during the next downturn or major crisis, or even little minor crisis like we've actually seen in China and with Deutsche Bank, etc., that forces the governments to step in again and give them taxpayer money to support the banks. And what does that do? Makes the public go, wow, what you really care about, what you're really underwriting is not the public, it's the banks, and that hurts confidence. So we know that confidence in both the central banks as well, I think that Congress is just a little bit lower than central banks in the level of confidence that the public has. So once confidence is lost, that's the biggie. That's why you're always hearing them talk about consumer confidence and market confidence and this confidence, inflation confidence, because it's all in our perception. And there are a lot more of us than there are of them. So this kind of behavior, this sovereign doom loop, it just goes around and around, definitely has an impact on the confidence. The other thing that's huge is the collateral doom loop, because what Wall Street has really done has created all of these intangible products, and particularly where we're going into derivatives, they're derived from something that's physical, but they don't have to have any relationship to that underlying asset or instrument. However, at some point it does get reflected. So we saw that in 2008 was the worst year since 2018 was the worst year for stocks since 2008. That's crisis level, okay? But even though they want us to think everything is hunky-dory. REITs are real estate, and we know that the real estate market has been imploding, and that's going to impact the REITs. We know that the bond curve has inverted. It did this in, 12/4 for the first time. So a little bit more than a month ago was the first time since 2008 that we've had a bond conversion. But again, when interest rates go up, which was what pushed us into the inversion, was Fed Pal pushing up short-term rates and the longer-term rates coming down because the market's going, no, things aren't so great. But that has an impact on those principal values. It's not good. And then finally are the derivatives that are really tied to all of this: stocks, bonds, real estate, and other derivatives. The CLOs are very similar to the CDOs that blew up the system in 2008. When those credits froze. And then we know that the CLOs, the collateral loan obligation, we just spoke about it yesterday, we'll talk about it more in the future, are baskets of these leverage loans. So leverage on top of leverage. Now, since they don't have to have, derivatives don't really have to have any real price relationship to the underlying, and we've had a lot of pension funds buying into the CLO market, even as the leverage loans were declining underneath there, you still saw the prices of CLOs being market price being maintained, but not anymore. And what we don't know, and nobody is going to really know this, nobody knows this now, I don't know if we'll ever really know it, but we really do not know the level of value that is at risk. What we also know is that as long as you pay the fee, you can keep bad derivatives floating. So that goes back to that first with the intermediary doom loop. The banks have got to, the central banks have got to, the governments have got to keep that money flowing so that the banks that create these derivatives, and you know what, it's like at least 20 times or 200 times global GDP, we have to keep the bad derivatives floating. We took a lot of them off the balance sheets of the bank in 2008, 2009, but there's all those legacy derivatives that still exist that were not, that are just kind of floating out there waiting for the next crisis. Plus, we've grown a whole lot more. And the CLOs are what took over for the CDOs. And I can't guarantee this, but I got to tell you, with what I'm seeing in the what's happening in the yield spread, that market has already begun to break down in a rather big way, and you have this mountain of debt that needs to be refinanced. I really don't care what the talking heads on TV or even Fed Chair Powell or whatever, their job is to keep you in the markets. They're not talking about this, and they're not being honest with you about it. But we will be. And then we've got the hedging doom loop. Because since they have all of these derivative, intangible derivative products, and now we have a massive increase in volatility, which we didn't for 10 years thanks to the central banks, that changes everything. And so just as quickly as you can flash your eye, think back to 2008, when those CDOs went bad, bam, 24 hours. Remember that? Because I remember that. And look at this graph. This was the beginning of February. That's when, it was the end of January, beginning of February, that the market started breaking down, which you might recall I was kind of surprised about because of the tax law changes that pumped a whole lot of money, or made the corporations look like they were making more money, and also pumped a whole lot more cash into the system. Now, they needed to do that so maybe they could retire some of the debt, but I showed you the debt wall yesterday. And it's and they're losing the ability to borrow in the fringe. So what these derivatives and these ETFs, which is a derivative products, do is they exacerbate everything. They create that herding mentality, and that could very well be, and my bet is that this is going to be what's going to happen, that will overwhelm the markets or the central banks or the plunge protection team's ability, or the buybacks that certainly done that already. It'll hurt their ability to go in and support these markets and keep them up. That means that this is most likely the one that's going to cause the markets to freeze, and you to, if you have any wealth held in there, to not be able to get it out. Because ultimately, it really does all go down to the real economy, which frankly, their real economy and the economy that we live in is kind of two different things. But there are links below, so you definitely want to check this out. And Deutsche Bank came out with 30 risks to the market in 2019. I go in, follow the link, read them all, but in essence, this is what they were talking about. Because they know that when those algorithms get going, there's no human hand to put any kind of reason in there. And that's that momentum trade, and why we see the level of volatility and insanity in the markets right now, because we know that it is primarily by a very wide margin, I think 85 or 90%, driven by those algos. In addition, what we're seeing on a global basis, even in this country, we just got the ISM numbers, that all the leading indicators are pointing to a slower economy, which means that, and we've already entered the earnings declines for 2019, and what came out today in the retail sector was not good. We'll talk about that next week. But slowing corporate earnings means that maybe there'll be more layoffs. It'll hurt the ability for them to borrow so that they can refinance this wall of debt. A lot of things. It's a very, very big deal. Higher interest rates also on already issued debt, as we just talked about, that impacts the value of these corporations. And so if their value is now lower, it's harder to command a higher stock price, even with the financial engineering of stock buybacks. So you're starting to see, I hope, how all of these things just feed upon itself. But the real kicker, and the most important one in here, is the fear that in this next downturn, because of all of the garbage that's been going on, the high balance sheets, the low interest rates, that they'll start QE again. They're not going to have any choice. And my bet is it'll happen this year. Maybe I'm right, maybe I'm wrong. Time is going to tell us. But their fear is that when they do that, it's not going to work. It's like pushing on a string. They're seeing this behavior in China and other places. That's really the biggest fear. Because if they do all of this stimulus and it doesn't reinflate the economy, that's not the economy, the markets. It didn't really reinflate the economy on the street, just the markets. And so the elites, the 1%. If it doesn't do that, then the rest of the confidence is lost, isn't it? And there is your hyperinflation. And there is your reset. And this is how gold responds. Even though these are still from the fiat markets, it's pretty obvious to see where the real safe haven is and why central banks have been accumulating it at the fastest level since the sovereign debt crisis in 2015. So, did Dustin post the...
Not yet. But
not yet.
Any day.
Okay, so that'll be any day. It was really a good interview, so I suggest you watch it. And next week we have SGT, and don't forget, this is definitely the time for those that are accredited investors to, if you haven't done so already, I think we only have we've only got a few seats left. But you need your strategy. You've got a plan. And so we're doing that comprehensive workshop. It's all weekend long. We're going to make it fun as well as interesting. But by the time you leave, you should have your strategy well in place. And you really need it now because of where we are in this cycle. So that's it for today. Keep in mind that shields are made of metal, not promises or paper. And until I see you next week, please be careful out there. Bye-bye.